Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, December 2nd, 5:16 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the big show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's important for next week, and update the world-famous 21 over 21 leaders list. Let's get right into it. State of the market. Bear market rally. Still leaving the bear market rally on there, although we've taken, let me explain this. We've taken long-term from downtrend to neutral because we got our weekly close above the 200-day moving average and the 40-week moving average, but we didn't get the 1% close above there. And that's the criteria that I've used for all the back testing that I did on generating the stats for bear market. So I'm going to leave bear market rally on there until we see a little bit more strength or we get a weekly close at least 1% above it. But today, definitely good news for the bulls, although it didn't start out that way. So let's check the trend gauge over here. Market leaders still on bullish / uptrend, which they've been since October 24th. Short-term trend has been bullish / uptrend since November 11th. This means all 5 of the major indexes are trending above their short-term 21-day exponential moving average. They're also trending above their medium-term 50-day moving average. And every index except for the NASDAQ 100, the QQQ, is trending above the long-term 200-day moving average. Didn't make any sense with the weekly close there to keep it on bearish despite the 1%, but I do want to make that caveat known that we didn't quite get to that level, but certainly closed the day in much better shape than we started it, because what just happened today, the jobs report came out. So let's step back. So Monday, we had a gap down and a close below that key fib level we've been looking at, 4,007, and that was an ultra short-term change in trend. We closed below the 8 EMA for the first time, and we followed up on Tuesday with minimal losses, but still a little bit lower. Wednesday, we opened flat, and we were basically flat waiting for the big Jerome Powell 1:30 speech and Q&A session. And his statement was dovish, and the Q&A was dovish, and the market took off to the upside there. S&P closing up over 3%, NASDAQ 100 closing up over 4.6%. My thought was he was so dovish because he already knew that the Thursday data that was coming out, which was inflation related, was tame, and it was, and that he knew the jobs report data and wasn't concerned about it. But I was clearly wrong there. The jobs report was very strong, stronger than, in fact, there were no weaknesses in the jobs report whatsoever. The economy pretty much firing on all cylinders from an employment standpoint. I know there's been a lot of tech layoffs announced, but they're not showing up in the statistics yet. We beat on number of hires, and we also average hourly earnings, unfortunately, was double what was expected. That's a very negative, and it's inflationary, and the market gap down back below the 200-day moving average, basically right to that 4,007 fib level at the low of the morning. And then by the time we opened down 1.15% on the S&P, 1.6% on the NASDAQ 100, but we put in the low within the first 15 minutes. And then we just started climbing higher. Got up to the 40-46 level, which is where the 200-day moving average is, and backed off, got above it again and backed off, got above it a third time and backed off. This time and then the fourth time, actually, and then we played back and forth for about 2 hours, right around that 40, between 40, this is crazy, I'm looking at the 1-minute chart, between the 40-46 and 40-56 level. We bounced around there for a couple of hours, and then we finally broke higher in the afternoon all the way up to 40-80, pulled back and tested that level again and held it and rallied a little bit into the close, and that was an excellent close for the bulls. Absolutely best case scenario considering that any news that is inflationary is not what the Fed is looking for to change their stance, to do this pivot that everybody's anticipating. And we got the bad news and we reacted negatively initially and positively throughout the day. And that's a big win for the bulls. So jobs report gap down under the 200-day moving average, but undercut and reclaim by the end of the day. Definitely good news for bulls. Growth stocks outperform the S&P also. So the G6 up 0.2%, S&P 500 down 0.1% on the day, NASDAQ 100 up 0.4%, Dow and mid caps barely positive, Russell 2000 small caps up 0.6%, global diversified 60/40 up 0.05%, in-house GROTECTION on the day up 0.19% for the week. All the indexes positive. We lagged down 0.3%. Again, this was part of that transition where we got some stops hit on Monday with the reversal back below that key area. And then in the course of 15 minutes, we jammed to the upside. We had about 50% exposure when that happened. We've added exposure throughout the afternoon on Wednesday and on Thursday and more today when we reclaim that 200-day moving average, and we'll review that when we go through the tail of the tape. So we're set up to outperform going forward with the holdings that we have. In fact, the stocks made up all the gains today that we had because our index ETF was down on the day. Good performance by quite a few leaders. We cut one that closed below the 21-day moving average, but we added two, and we added to our index long. And again, we'll discuss all that when we get to the tail of the tape and the updated 21/21 list. So let's get into it here. You can see the trend gauge. What do we do at Revere? We are a registered investment advisor that manages individual client accounts in an active way depending on the health of the overall market. You saw the trend gauge on the following or on the preceding page. Those four categories dictate how much we have exposed to the market at any one time. Are leaders acting well? Are we above the 21-day on the indexes? Are we above the medium-term 50-day? Are we above the long-term 200-day? And that guides that's our governor, so to speak, for how much exposure we have to the market. When things are trending well above all three, like last October, November, we're as fully committed to the market as we can be. If things start to go sideways or roll over, we'll pull back a little bit. If we start to trend lower, that means the slopes of the lines of the short term and medium term will start to roll over and we'll take more off the table. And if we break this black line, the 200-day moving average, that's when we get maximum defensive in posture because of these stats right here. We're just not going to burn our clients' nest eggs while the market is unhealthy. You can see how harsh these drawdowns are. They all occur under that black line, under the 200-day moving average. And this year, January to October, we're down 27.5%. If you rode that the whole way down, you need 38% to get back to normal or even. At the worst, we were down 11.5%. We're gaining some of that back now as our short-term rules, and I go over it in this weekend's podcast in detail. I flash back to 2008, 2009, and applying the same rules that we would have applied then to the current market, showing how we get back in. And it's just a combination of our short-term, then medium-term, then long-term indicators, and factoring in how leading stocks are doing. And with this big test, with the gap down today and the hold of the 200-day and closing at the top of the range, that's really good action for the S&P, and we put some more money to work. You can see the gap down, the low early in the first 15 minutes, then just starting to work our way higher. Higher highs and higher lows. That's the definition of an uptrend. Then we pull back. We held the high from prior in the day, higher highs and higher lows. And all in all, really good action. Let's look at a 60-minute chart here. This is the big move up on the Fed, flag the gap down and reclaiming most of that, just finishing down a fraction. Excellent action. Exactly what we want to see from from stocks when they're going under a stress test, so to speak. I like that term. Got it from Ray at Trader Lion and his the way that he analyzes the market. It's a good term. Banks undergo stress tests to see what they can handle. Stocks undergo stress tests too to see how they'll react. So here's the NASDAQ 100, bounced at the ADMA. At the low, pre-market, we got right to that key 286.82 level, that key Fibonacci level. We bounced right off of it, closed near the top of the range. Positive action there. Same thing with the Dow Jones Industrial Average. Gap down, held 34,000, closed near the top of the range. Mid caps bounced at the ADMA, closed at the top of the range, and small caps. Stop me if you heard this one before. Bounced at the 8 and the 200 and held the 200 and closed near the top of the range. So great action across the 5 indexes. Now let's take a look at first the equal weight indexes. RSP, same thing, bounced off the 8, well above that 1% threshold versus the 200-day moving average, which I'm applying to the S&P from the back studies that we did, but 3.4% above on the RSP. Let's look at the equal weight NASDAQ 100. Closed the week above the 200-day moving average by 1.1%. So again, those big FANG stocks are still lagging, still dragging the market down because of their heavy weights in the S&P 500 and the NASDAQ 100. So there's the equal weights. Something else that we saw today. The dollar gapped up. Look at an intraday chart here. The dollar gapped up on that employment report. And then, again, it topped in the first 30 minutes and then started trickling lower. Dollar down, stocks up. That's been the inverse correlation, and it happened today also. Same situation in the opposite situation in the price of bonds. The TLT gap down. Price down means yield higher, but the TLT, you can see, trended higher all day long. Let's go to the 30-year, the TYX, gapped up and then lower lows on interest rates. So the market just absolutely shaking off the inflation data, the perceived inflationary data from the employment report, and that's an excellent sign for bulls. Look at this trends down over Thursday and Friday in interest rates. Lower rates good for the economy, but a strong economy bad for inflation. But the market is shaking it off, plain and simple. Let's look at the VIX. The VIX continued lower, even when the indexes were red today. The VIX barely red, and then or barely green, and then turned red. In fact, it was a precursor showing that stocks were going to go higher, and it did. We closed at the lows of the day for the VIX, below this 20 level, continuing the trend lower beneath the 21-day exponential moving average. How about gold? What's gold doing? Gold gap down, closed at the top of the range, right under the 200-day moving average. How about Bitcoin? BITO, tight inside day relative to the prior day's action. So what else? Did I cover everything? How about junk bonds, JNK? Junk bonds, just like bonds, gap down, closed at the high of the day, and again, just not a risk-off signal from a credit standpoint, the fact that they're acting well. So those are all the key indexes. Let's bring up the tail of the tape now, and then we'll get to the 21 over 21 list. So same headwinds from a macro perspective, but some of them are shifting now. Inflation data, we got a tame inflation report, but we did get a strong jobs report today, and interest rates have been coming down. Fed continuing their taper and balance sheet reduction, and the dollar's weakening. So some of these changing from headwinds to tailwinds. Technical standpoint, we're good. We're oversold on the yields, and on the dollar, but oversold can get more oversold. Sentiment put call kind of low at 0.84. VIX below 20 now. 19.06, down 4% on the day. Fear and greed at 63, operating under the bull case. Here's the news with the strong jobs report, 263 versus 200. Average hourly earnings up 0.6% versus 0.3%. The initial reaction, yields up, dollar down, stocks dollar up, stocks down. By the end of the day, yields down, dollar down, stocks up. Well, not up completely. The S&P and the NASDAQ finished red, but just barely, but well off their lows. Day count, up one with 2 consolidation days. And there's an OPEC meeting from an oil standpoint. OPEC meeting on Sunday. They're expected to make some production cuts. So expectations coming in today, positive as long as we could stay below that 200-day moving average. Certainly the gap down didn't support that, but turned to a bullish undercut and reclaim on the S&P and the NASDAQ of these key levels, the 200-day and 290 on 200-day on the S&P 500, 290 on the NASDAQ 100. S&P 500 ATR continues to shrink, to reduce, to get less volatile, and that's being reflected in the VIX, and that's generally good for stocks also. So you can see the closes. What was strong today right out of the gate? Solar strong, oil services strong today, but oil stocks themselves, the producers not as strong, and the broad diversified stocks not as strong. Coal strong, biotech very strong, XME strong, TLT started down, finished up. Bond yield started up, finished down. The dollar started up, finished down. Semiconductors weak, software weak, tech in general weak. Here's our focus list. We'll take a look at them when we go through the 21 over the 21 list. In-house, we sold GFS. I'll review that chart when we go through the 21-21 deletions, and we added 3.3% to our leveraged long on the S&P 500, so that's up to 20%, which is the equivalent of being a 60-40 portfolio. If 60% is in the S&P 500, that's where we are right now, and then the rest of the portfolio being used to buy the best growth stocks. And today we added Boeing and we added ANET, 3% Boeing because it's got a lower ATR, 2% ANET, our initial buys on those. We'll detail those when we go through the charts. Also, that takes our adjusted beta from basically 1 to 1.15, so 15% more risk than the S&P 500. Theoretically, this means if the S&P is up 1%, we should be up 1.15%. The S&P is down 1%, we should be down 1.15%. But with the market, with the wind at our backs, with the test and hold of the 200-day, that's our signal to put more risk on, and that's what we're doing. So bottom line for the week, strong jobs report gap down under the 200-day, but turns to a bullish reversal to the upside. You can see these two real tight closes, both of them above the 200-day moving average, with the undercut and the reclaim. Bulls really couldn't ask for a better day today, all things considered. So let's get to the 21 over 21 list. And as usual, we'll start with 6 deletions this week, and that's because of sector rotation. So let's take a look at the 6 charts that we punted. First one, GFS. This was something that we held and we got stopped on part of early in the week, and the rest of it today as we closed under the 200 or the 21-day exponential moving average, relative straight lagging over the last 2 weeks on GFS. Still a great story, but stocks have a job to do, and when they don't do them, we got to get rid of them. MEDP, MEDP, very volatile as of late. Big undercut and reclaim of the 21, but then gave it up again by the end of the day. So that comes off. There's no reason to keep a laggard on this list when there are easily 75 stocks that I could put on here that are liquid enough and acting well enough. So we got to get the cream rising to the top. Exxon, this is part of that sector rotation I was talking about. Look at the relative weakness over the last 4 weeks on Exxon. That's been the same thing for oil. The stocks, for the most part, are holding up better. They may just need to come down to oversold and then hook back up. That might be a target at the 50-day moving average, and it might be a spot to re-enter them. But for now, the 21 is rolled over and it closed below it, so that was taken off. CEG, an alternative energy stock that's been on for a while, gapped below, couldn't reclaim it, so that was taken off. SHLS, we got stopped on this yesterday because of the secondary offering that they did, gapped below the 50-day today, closed at the top of the range, good action, big volume. This may come back to something that we could possibly own. DINO, this is one of the best acting oil explorers and producers. Not this week, though. Look at that selling volume and this harsh move today, down 7%. I didn't see any news, but this is keeping with the general weakness in oil stocks. So those are the 6 that got kicked off. These first 6 that I'm going to show now are the 6 additions. And if we own them, it'll be flagged. I'll bring that up also. So let's get started. KLA 10 Core. Very nice cup and handle-ish pattern within this overall flat base, showing relative strength. Semiconductors have shown relative strength relative to the NASDAQ 100 during this move up in stocks. My dog getting a little bit excited. I think the pizza's here. Okay, Charles Schwab looking good, trending above its cup and handle breakout. Deckers, luxury retail, outperforming low dollar retail this week. Lulu also looks good, but it has earnings next week. Deckers was on our list a while back, gave it up, then had a gap up here, and now just trending very nicely above the 80 EMA. Next up, Halliburton. This is an oil stock. The oil services stocks have been outperforming this week, and Halliburton is definitely one of them. So I don't have an explanation for why oil service stocks are outperforming while the producers and the diversified companies are underperforming, but Halliburton's on there. I've noticed this for a while, and I want to get it on the list. Next up, 5. This is what we bought yesterday on the big volume gap up. They've got the N factor and a nice consolidation inside day today, closed in the upper part of its range. Good action for a day 2, considering what was going on with the market today. Netflix, we also added 3 days up. We bought it this week. Big move on volume on Wednesday, higher on Thursday, higher on Friday. Look at the volume here. You can't miss this. Compare it to when it's consolidating. On the days that it's higher, look at all the volume. It's consistent, and it's actually goes all the way back to its prior earnings report, where it started subtly. The relative strength line started ticking higher. All the pullbacks on it have been on lighter volume, but when it's being bought with volume. Celsius, we own this also near the top of this base now. ON Semi bounced at the 21. Boeing, we took a position in this near the close today. After late afternoon, after it gapped down with the rest of the market, and then some news came that one of the airlines is going to be ordering a bunch of planes from them, and that Boeing's really had nothing but good news since early November, when they announced that they expect to be cash flow positive next year. I put it on the watch list, watched it tighten up for 3 weeks, was looking for a catalyst to move it up on volume, and I got it today. So we took the position in Boeing today. Wing, undercut but reclaimed the 21 by the end of the week. Mobileye, new closing highs since the IPO. We own this. Caterpillar, good consolidating action near the top of the cup. ANET, we bought this today. I've been talking about it in the videos for a while. It's been on the focus list. These types of stocks, you need to buy them on weakness. That's what the feedback that I've been constantly getting over the last couple of months. Buy the strongest stocks on weekdays. That's what's been working. Good low risk entry versus the 21-day exponential moving average. First Solar, we own this. 2 consolidation days after a big volume move up on Wednesday. Impinj, bounced off the 21, continuing to hold up well. AEHR, watching this one, continues to trend higher. All weakness continues to get bought. O'Reilly, continues good action around the ADMA. Scorpio tankers, this was certainly not weak today with the rest of the oil stocks up 6%. And the catalyst here is the transportation of LNG to Europe. Hess, the international oil stocks have held up better than the domestic stocks. This one's still clinging to the 21. Steel Dynamics, our second biggest holding, nice move today. Great volume over the last 2 days, closing at highs for the week. And Eli Lilly trending higher, earnings in 2 weeks. And that is your updated 21 over 21 list. And I am going to call it a wrap for the week. So remember, it's not how much you make in the market, it's how much you keep. We've protected capital throughout the year while we've been in this bear market. We had a monstrous lead over the S&P 500. A couple of these big gaps up have cut into that because our exposure was lower, and we've gotten stopped out a couple times. I talked about this in the podcast. This has been a much more difficult trek higher versus what happened after 2009 and what happened on this move off of the lows. But great action over the last week. There was a lot of news this week that could have derailed the market. And the bottom line is that we got above the 200-day, back tested it multiple times and held it. And until that fails, the bulls get the benefit of the doubt. And that's what we'll be watching for next week, is this 200-day moving average. So wrapping up the week ending December 2nd, this is Don Vandenbord telling it like it is. Again, remember, it's not how much you make, it's how much you can keep. Thanks for listening and have a great weekend.